Joyce, this is the second triple R cut this year. In terms of the outlook, do they move again in early February, or do they wait for these latest measures to percolate through the system?
I think that, you could wait. I think there was some hesitancy as well. But again, we see the economic numbers picking up. And we do think that the worst of the defaults are behind us. Now, you're still going to have a very elevated default rate in the property sector, looking at around 16%. But the market was pricing in 40, 50% default rates. So I think what you could see is more supplementary targeted measures. And so now we are seeing that mortgage approvals, they're loosening this up. Some of the restrictions that they had put on M&A loans, they're loosening this. I think it could be some other measures that are not so focused on the macro side, but much more on the credit side directed at the property sector.
Is CAISO the next shoe to drop, Joyce, in the China high-yield property space? And is any potential spillover manageable, or does it pose, again, systemic risk?
I don't think that the risks are systemic. It's also not idiosyncratic. So I think you're going to continue to see stress in the property sector. I would say for another quarter or two, this is still going to be the case going forward. But the market has moved pretty far in pricing a lot of these issues in already. So I think if anything, there's probably some opportunities for bottom fishing here. I mean, when we look in the bond market for China high yield property bonds, at 3,000 over, you're pricing in a 50% default rate. And I don't see a scenario where that is going to happen. So I think that, look, the real downside risk to the growth still comes from the property side. That remains the case. That's the biggest near-term risk, and that's going to continue for the next couple of quarters. And I don't think the triple R cuts are going to be enough.
So the monetary authorities need to take even bolder action, Joyce, do they?
Well, I think it's really going to be much more targeted. They will do things like look at specific, specific cities, to meet the mortgage demand for upgraders, for first-time home buyers. That they're release M&A loans. You also see that the regulators are more focused on this as well. So I think targeted measures is probably more of what we will see rather than necessarily saying it's going to be big structural macro policies. I think the Chinese are trying to really shift away from the macro and the industrial, being completely aligned, which is what we've seen in the past. But I think some differences are going to emerge going forward.